Welcome to EduTap and welcome to the Finance 360-degree sessions in which we cover the relevant and important finance, current affairs and the RBI notifications which are important from your exam point of view. And in today's session, I have brought for you a very important notification that has been recently released by the Reserve Bank of India. Okay, so this is the RBI has revised the bank's capital market exposure norms for T+1 settlement. So here this notification that the RBI has recently released is very important from your exam point of view. There are the data points that you have to understand for the phase 1, for the phase 2 perspective from both of the levels perspective. The notification, the news article is very important. Okay, and this is somehow related to SEBI also. So for the SEBI examination, for the RBI examination, for both of these, this news article, this RBI notification is very important. So today we are going to break down this notification into smaller parts, into smaller chunks, so that you are able to understand this very typical kind of RBI notification. Okay. So good morning everyone. So good to see all of you here. So let's get started. But before that, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, as well as join our Telegram channel for the PDF of this session. Okay, so join the Telegram channel so that you can get the PDF of the session, and the link for the Telegram channel is provided in the description box below. So let's get started. So today's news article is regarding the RBI that has revised the guidelines for the custodian banks to issue irrevocable payment commitments in light of the T+1 settlement regime for the stocks, for the shares. So we have to understand that what are the new guidelines, what is the change that has happened in the guidelines. Okay, so the Reserve Bank of India has said that the custodian banks that provide the custodial services. So here you can see that SDFC Bank, Axis Bank, and there are multiple banks that provide the custodial services in our country. Okay, so these are the banks that are providing the major financial services. They are providing the custodial services. That means they are the custodian of the financial assets for the big entities, such as for the mutual funds, for the foreign institutional investors. The custodian banks are the providing the custodial services. They are the custodians. Okay, so custodian is responsible for keeping as well as safeguarding the investments and securities on behalf of the owners. Okay, so mutual fund company as well as the foreign institutional investors, they require an organization or a bank to hold and safekeep the records of its assets, the investments that they have done. Custodian helps ensuring that the interest of the investors by keeping track and ensuring the safety of their instruments that they have invested in. So the custodial services are very important because for the mutual funds in our country, it is compulsory to have a custodian. Okay, so that for the mutual funds, the custodian is the one that is safeguarding and that is keeping the track of all the investments, all the assets that the mutual fund has invested in, all the securities that the mutual fund has invested in. So for the mutual fund in our country, it is compulsory to have an organization or a bank to hold and safekeep the records of its assets and of its investment, because so many of the people have invested in the mutual fund. So if the mutual fund is not keeping the track properly, so you can understand that it will affect so many of the other people if there is any wrongdoing that happens or any misplacement of the assets or investments happen. Okay, so that's why there is the custodial service that is required. So for now we have understood that what are the custodian banks. They are the banks that are providing the custodial service for the assets, for the investments to the mutual funds and to the foreign institutional investors. So what is this irrevocable payment commitment? So now the custodial banks, they can also provide the irrevocable payment commitment, that is the irrevocable confirmation issued by the custodian bank. So what happens that, let's say that the mutual fund wants to invest 10 crore rupees in the shares of Reliance Industry. Now the mutual fund, for now, the mutual fund does not have that much money in its account, or let's say it has the money in its account, but there is the irrevocable payment commitment that is required. Let's say that for the stock exchange, for the stock exchange, the mutual fund does not have the 10 crore in its account on the T day, that is on the trade day, but the mutual fund knows that by tomorrow I am going to get this much of the amount, and so by tomorrow the settlement will happen. So T+1 means that the trade is happening today, the trade initiation is happening today. So trade is initiated today, but the trade will be settled tomorrow. The trade will be settled in the next day. So for the mutual funds, you can understand that mutual funds know that by tomorrow they are going to get this much of the money. So they want to invest this money in the Reliance Industries. Now the stock exchange will say that give us the money right now, but the mutual fund will say that I will give you tomorrow on the settlement day. So here the banks, the custodian banks, they provide the irrevocable payment commitment that even if the mutual fund is failing tomorrow, we are the ones that will be responsible, and this is the commitment from the bank that bank will be providing you the money. So this is how the custodian banks on behalf of their client, that is the mutual fund here. So the mutual funds are the clients of the banks, custodian banks. So mutual funds are the clients of the custodian bank, and on behalf of the custodian, on behalf of the mutual fund, they can give the commitment. Okay, so that is like the guarantee. So they are the irrevocable payment commitment, which is in the nature of a financial guarantee that they are giving on behalf of their client. So that is the idea. Irrevocable payment commitment, it is the irrevocable confirmation issued by the custodian bank in favor of a stock exchange or clearing corporation of a stock exchange on behalf of its customers. So on behalf of its clients, on behalf of its customers, the bank is the one that is giving the confirmation, the bank is the one that is giving the commitment that if this customer fails, I will be the one that will be providing you the money, so that the continuation of the function can happen of the stock exchange. Okay, so that is the idea. So for the financial, so for the foreign institutional investors also, the irrevocable payment commitment can be provided by the custodian bank, because for the custodian bank, the financial institution investors are also the customers, are also the clients of the custodian bank. So authorized, here you can understand that the irrevocable payment commitments in favor of the stock exchange or the clearing corporation of the stock exchange can be provided by the custodian bank on behalf of their registered foreign institutional investors clients for purchase of shares and convertible debentures under the portfolio investment. So the irrevocable payment commitment can be provided on behalf of the clients, on behalf of the customers by the custodian bank, so that the stock exchange know that even if the mutual fund or even if the foreign institutional investors are not able to provide the money, the bank will be has already provided the commitment, so the bank will be providing the money. So irrevocable payment confirmation, it is the financial guarantee that is issued prior to receipt of the required funds from the customer. It will be reckoned for the computation of capital market exposure that we will be understanding. But the basic idea, I hope you have understood, that if the mutual fund or the financial institutional investors, they do not have the money right now on the T day when they are initiating the trade, but they know that by tomorrow they are going to receive the money, then they are going to initiate the trade. Let's say they want to have the 10 crores worth of Reliance Industries shares or any other industries shares. So the custodian bank is the one, because these are the customers of, they are the clients of some particular custodian bank, let's say Axis Bank. So the mutual fund and the foreign institutional investors, they are the customers of the Axis Bank, because they are keeping their securities, they are keeping their assets with the Axis Bank, they are keeping their investments with the Axis Bank. So they are the customers of the Axis Bank. So now if they want to invest but they do not have the money right now, so the Axis Bank can give the financial guarantee. Like on the behalf of the public sector companies, the public sector undertakings, the state governments are the one that can give the guarantees when the public sector undertakings are taking the loan. In the similar manner, on behalf of the mutual fund and the foreign institutional investors, the custodian bank can give the financial guarantee, that is the irrevocable payment confirmation. Okay, I hope this much is clear. Give me a thumbs up. But when you are giving the confirmation, what if the mutual fund actually defaults? What if the the foreign institutional investors actually defaults? So there is the risk that is attached when the custodian bank is giving the confirmation. So that much is clear. it was decided by the Reserve Bank of India to put in place adequate risk mitigation mechanism to protect the banks here, to protect the custodian banks that are undertaking the service of providing the irrevocable payment confirmation for some margin, for some benefit, for some profit, that okay, we are providing you the irrevocable payment confirmation, but we will have 5% of whatever profit you make, or we will have 2% of whatever profit you make. So that is what the custodian banks are doing. This is a business model, you can understand, but it has some risk attached. The banks are giving the loans, so that is also risky. The banks are giving the irrevocable payment confirmation here, so that is also risky. So to protect the banks from the adverse movements, now let's say that the domestic mutual fund defaults, or the foreign institutional investors, they default. So then what will happen? If they are defaulting, that means the custodian bank has given the confirmation that okay, if the mutual fund or if the foreign institutional investor is not paying, I will pay. So custodian bank, if they are defaulting, actually the custodian bank will have to pay for the settlement and will get the securities. What if the price of the securities fall? Then the custodian banks will be making the loss. So to safeguard the custodian banks from the, or to mitigate their risk, not safeguard, the RBI cannot safeguard them because they are taking the risk, but the RBI has said that you have to mitigate your risk. Okay, so risk mitigation mechanism to protect the banks from the adverse movements in the equity prices, in the share prices, and the possibility of the default by the domestic mutual funds or the foreign institutional investors, while ensuring that there is no undue disruption in the functioning of the capital market in the country, because the settlement has to happen. There are the sellers. Reliance industry has also has already given the initiation of the trade to sell the 10 crores worth of shares. So the capital market, it will be a big blow in the functioning of the capital market if the trade is not settled. So that cannot happen. The custodian bank has already given the confirmation. So for the capital market functioning to happen smoothly, but as well as to mitigate the risk of the banks, there is the guidelines that has been released by the Reserve Bank of India that are known as the Bank's Exposure to Capital Market Issue of Irrevocable Payment Commitment. So this guideline was released in 2011. So 2011, when there was the T+2 cycle that was going on. Now the Reserve Bank of India has said that as there is the T+1 cycle that have started in the country, that is before there was T+2 cycle that was going on. So that is trade plus 2 days. So there were extra 2 days that were given for the settlement. Let's say on Monday the trade is initiated, Tuesday, Thursday. So on Thursday the settlement will happen. On Thursday the settlement will happen. But now there is the T+1 cycle that is going on. So on Wednesday. So on Monday the trade is initiated. So plus 2 days means on the second day, that is on Wednesday, the trade will be settled. Now there is the T+1 cycle that is going on. That is on Monday the trade is initiated. So on the next day the trade will be settled. By Tuesday the trade will be settled. So this is the idea that there is the T+1 cycle that is going on in the country. Okay. So now when the guidelines were made in 2011, they were made as per the T+2 cycle. But now the T+1 cycle is going on in the country. So the RBI has said that we are updating our guidelines, we are revising our guidelines so that we are catering to the T+1 cycle. So as you know that from January 2023, we have completely moved towards the T+1 settlement cycle, and this is fully implemented for majority of the shares. So that's why the RBI is saying that the risk mitigation measures that were prescribed before that were prescribed in 2011, they were based on T+2 rolling settlement. Rolling settlement means on Monday the trade is initiated, Tuesday, Wednesday. So on Wednesday it is settled. On Tuesday the trade is initiated, so that will be settled on Thursday. On Wednesday the trade is initiated, so that will be settled in +2. So that is a rolling settlement that happens. So the stock exchanges have since introduced the T+1 rolling settlement. That is, now we are following the T+1 rolling settlement majority in the major trades, and accordingly the existing guidelines on the issuance of the irrevocable payment commitment has been reviewed, has been revised. So this has happened on May 3rd, 2024, that there is the revision of the guidelines by the Reserve Bank of India for the custodian banks for the irrevocable payment commitment. So we will understand that what are these new guidelines and what is the change that has happened in the guidelines. Okay, so all IPCs, all irrevocable payment commitments issued by the custodian banks. Banks are under the Reserve Bank of India. So custodian banks under the T+1 settlement shall comply with the following instructions. So now let's understand the instructions. I hope till now everything is clear. Only 3 students are able to understand. What about the others? I want the thumbs up from all the students here. If you are understanding the point, tell me, because this is a difficult notification. I have explained to you what are the custodian banks. They are giving the custodial services to the mutual funds, to the big investors, we can say to the foreign institution investors also. We have understood that what is the irrevocable payment commitment. That is the commitment by the custodian bank that if the mutual fund defaults, if the big institutions institutional investors default, then the custodian bank will have the commitment to pay for the security, to pay for the shares. Okay, so that is the thing that we needed to understand. So now I hope this seems easy for you to understand. Let's continue with the instructions. So only those custodian banks shall be permitted, will be permitted to issue the irrevocable payment commitments who have a clause in the agreement, with clients. So let's say that this is the Axis Bank that is coming in contract, in agreement with some mutual fund. Let's say Quant mutual fund. That Quant is not from our country. Let's say some XYZ mutual fund. Okay, some XYZ mutual fund. So Axis Bank, it is it has the client XYZ mutual fund. Just a sec. So Axis Bank has the client XYZ mutual fund. XYZ mutual fund has decided to invest in the Reliance Industries share worth 100 crores, or let's say 20 crores. 20 crores. Now mutual fund, again it is going to, like, there is the T+1 cycle. So you can understand that the trade day is today. Tomorrow the settlement will happen. So the mutual fund is saying that by tomorrow I will give the money. Now the Axis Bank is saying, okay, I am going to give the irrevocable payment commitment to the stock exchange, that if the mutual fund is not able to pay for the Reliance Industries shares, then the Axis Bank is going to pay to the stock exchange or to the clearing corporation of the stock exchange. Now this can happen. This irrevocable payment commitment can be provided by the custodian bank when in the agreement it is already written. When they are coming into the agreement, when the Axis Bank and the XYZ are coming into the agreement, it is already written that in case of irrevocable payment commitment, if you want a irrevocable payment commitment, then whatever share will be bought in the name of Axis Bank. Understanding the point, only those custodian banks will be permitted to issue the irrevocable payment commitments who have a clause in their agreement, with their clients. So Axis Bank has a clause in the agreement with its client, giving the banks an inalienable right, the complete right over the securities to be received as payout in any settlement. That means if the Axis Bank is giving the irrevocable payment commitment, then the security will be on the name of Axis Bank. So that is the idea, okay. But however, the clause will not be insisted upon if the transactions are pre-funded. That means, let's say that the XYZ mutual fund already has in its account 20 crore rupees. So today the trade is being initiated. On Monday. On Monday, the mutual fund already has 50 crores in its account. So that means the mutual fund will be able to pay by tomorrow. That's the idea, that the money can be blocked actually. So that's why the irrevocable payment commitment, even if the custodian bank is giving the irrevocable payment commitment, but there is no insistence upon the security coming in the name of the Axis Bank. So that is the idea, that if the mutual fund in its account has enough money, so and then the custodian bank is giving the irrevocable payment commitment for the mutual fund to the stock exchange, that for sure the payment is going to happen. Do not worry about it. So Axis Bank is the custodian bank that is giving the irrevocable payment commitment for the mutual fund to the stock exchange. On behalf of his client, the irrevocable payment commitment is given to the stock exchange. If the mutual fund already has the money in its account, then the security that will be bought will not be bought in the name of Axis Bank. But if the mutual fund does not have any money, or let's say it only has 10 crores in its account, then the security will be bought, then the shares will be bought in the name of Axis Bank, because it is giving the irrevocable payment commitment when there is the there is the default that can happen, okay, when the mutual fund does not have much money right now in its account, okay. So that is the idea, that however this clause will not be insisted upon if the transactions are pre-funded, that is either clear Indian funds, Indian rupees are available in the customer's account, or in the foreign exchange case, in the foreign institutional investors case, the banks, the custodian bank's Nostro account has been credited before the issuance of the irrevocable payment commitment. So in the case of the irrevocable payment commitment, only those custodian banks will be permitted to issue the IPCs who have a clause in the agreement that if they are giving the right to the, if they are giving the IPC, the irrevocable payment commitment on behalf of their client, then they will have the securities in their name. The securities will be in the name of custodian bank. But if the amount is already in the account of the clients, then there is no need for the money to come, for the securities to come in the name of the Axis Bank and such. Now, what is not clear? Jishan, is there any confusion? Tell me right now so that I can clear it out. So the maximum intraday risk to the custodian banks issuing IPCs would be reckoned as, so the maximum intraday risk that the custodian banks are having, that will be considered as capital market exposure at 30% of the settlement amount. Now let's understand one thing, that if the Axis Bank is giving the irrevocable payment commitment, okay. So if the Axis Bank is giving the irrevocable payment commitment for the client, and the client does not have the money in its account right now, so the irrevocable payment commitment is given, and the shares that will come in the name of the Axis Bank, okay. So that is the basic idea. Now let's say that the client actually defaults, and is not giving the money. Then whatever the security that is coming, the shares that are coming in the name of Axis Bank. So what is the risk? If they are giving the money, Axis Bank is giving the money to the stock exchange, then they are receiving the shares also. So what is the risk? The risk is that what if the prices of the shares goes down? What if the prices of the shares goes down? Customer here, the client here is the mutual funds, the foreign institutional investors. They are the clients of the custodian bank, because they are the ones that are having the custodial services, okay. So is it clear? Let's understand this first. So the basic idea is that the Axis Bank is giving the irrevocable payment commitment. The Axis Bank is giving the irrevocable payment commitment, and it is getting the securities. If the customer, if the client, if the mutual fund is defaulting, then the Axis Bank is receiving, the custodian bank is receiving the security. The major issue here is that what if the prices goes down, okay. So the risk, maximum intraday risk to the custodian bank issuing the IPCs would be reckoned as capital market exposure. So this is the capital market exposure at 30% of the settlement amount. So if settlement amount is 10 crores, 30% of that is 30 lakhs, okay. So this is based on the assumption of 20% downward price movement. If the upward is happening, that is good for the Axis Bank. Axis Bank is actually having the profits. So there is no risk that is there. But what if there is the downward price movement? So that is the risk actually, okay. So the risk is considered, the capital market exposure is considered at 30%. The RBI has said that the capital market exposure will be considered the 30% of the settlement amount that is given to the stock exchange. So this is based on the assumption of the 20% downward price movement of the equities on the T+1 with an additional margin of 10% for further downward movement of price. So that is the idea, that on the trade day, let's say the price of the securities is 10 lakh. On the So on the trade day, when the trade is initiated, so on the trade day, when the trade is initiated, let's say the price of the shares are 10 crore. And on the next day, so now the trade has been initiated, the mutual fund will have to purchase the shares for 10 crore. Okay, that is 100 shares for 10 crore. 100 shares for 10 crore. So the trade has been initiated. By tomorrow, the 100 shares by tomorrow, when the trade will be actually settled, the 100 shares are of 7 crores only. That means there is the decrease in the price that has happened of the shares, but the mutual fund will have to purchase the 100 shares for 10 crore because the trade has already been initiated. So the mutual fund now is purposefully, they are defaulting, that we do not want to take this down, like we do not want to purchase the shares, 100 shares for 10 crore when we can purchase the 100 shares for 7 crore right now. So the mutual funds are defaulting purposefully, let's say they want to cheat. Okay, so if they are defaulting, if the mutual fund defaults but the custodian bank has already given the irrevocable payment commitment, so the custodian bank will have to pay this 10 crore to buy the 100 shares. So what has happened, that when the custodian bank is getting the shares, the custodian bank is getting the shares at the lower price. Like now the downward price movement has happened, so the loss will be made by the custodian bank of 3 crores. Okay, so that is the idea, that capital market exposure is actually the downward price movement that is happening on the T+1 day, when the actually the shares are coming to you. You are getting to know that on the next day, from the trade day, the next day, the share prices have been decreased. So right now the custodian bank has purchased the custodian bank has got the 100 shares. Even if the custodian bank sells the shares on today, so that will be sold at 7 crore or maybe less. So you can understand that that's why the RBI has said that there is the risk that is involved of the downward price movement. I hope this much is clear. Okay, so here let me brief everything. So the basic idea is that if the custodian bank is giving the irrevocable payment commitment on behalf of the mutual fund on the trade day, when the trade is being initiated, then the custodian bank, if the mutual fund does not have the money in its account, the enough money in its account, then the custodian bank has the authority to receive the security, to receive the shares. It should not like that the custodian bank is giving the money and then the shares are going to mutual fund. That will be completely wrong. So the RBI has said that if you are giving the irrevocable payment commitment and if the mutual fund does not have the money in their account, then you should be the one, then the custodian bank should be the one that should receive the securities also. Okay. Next point is that what if the custodian bank, what if the mutual funds have the money in their accounts? In this case, the irrevocable payment commitment is only given for the stock exchanges to understand that yes, the trade will be completed. Okay, but the mutual funds already have the money in their accounts. That means the whatever trade that they are doing is pre-funded. They have the funds that can be blocked by the custodian bank. So you can understand that in this case, the custodian bank should not have the claim over the securities. Is it clear now? Any confusion now? Nostro account is just the account that the foreigners are keeping in India so that they can send their money to India. Okay. So in case margin is paid in cash, the exposure will stand reduced by the amount of margin paid. So if the margin has been paid from the mutual fund to the custodian bank, let's say of 2 crores, so the risk will be reduced by the 2 crores. So that is the idea. Now if in cash it is paid, so that means the risk will be reduced or the exposure will be reduced by 2 crores. And so, but if the mutual fund is paying in securities or in any other form, so let's say that the margin is paid in the way of permitted securities, in way of some particular shares and securities to the mutual fund, or foreign portfolio investors are paying the margin in the way of permitted securities. So in this case, you have to take into account that what if the price of this securities fall down. So let's say the margin that is of 2 crores is paid through the shares. So these securities are worth of 2 crores. But what if their price falls down? So in this case, what happens that when you are giving the margin, when mutual funds, foreign institutional investors, they are giving the margin in the form of cash, the exposure will stand reduced by the amount of the margin paid. But if the mutual funds or the foreign institutional investors are giving the margin in the form of securities, first you have to take into account what if the price of the securities fall. So there is the haircut word that is used, that is what if the price of the assets fall down, or that is the discounted rate of the securities. So the discounted rate of these securities will be considered, let's say 1 crore 50 lakh instead of 2 crore. So the securities are currently worth at 2 crore, but they are taken at a discounted rate of, let's say 1 crore to 50 lakhs. Okay, so that is in case the margin is paid in the form of permitted securities to mutual funds or foreign portfolio investors, the exposure will stand reduced by the amount of margin after adjusting for a haircut as prescribed by the exchange on the permitted securities accepted as margin. So when the permitted securities are accepted as margin, they are taken at a discounted rate, they are taken at a lesser worth. Okay, under T+1 settlement cycle, the exposure shall normally be for intraday, that is for 1 day only the exposure will be there. However, in any case, exposure remains outstanding. So let's say that the payment has not happened, so the custodian bank is only going to take the exposure for 1 day, for the trade day when the trade is initiated, because by the next day the mutual fund can make the payment. But if the trade is not settled by the mutual fund, then the complete responsibility is coming to the custodian bank. So under the T+1 settlement cycle, the exposure should be only for the trade day, because on the next day it is believed that the mutual fund will pay, the foreign institution investor will pay. However, if by the T+1 the settlement is not happening, the mutual fund is not paying or the foreign institution investor is not paying, in this case the capital will have to be maintained on the outstanding capital market exposure. That means whatever the capital market exposure is, against that the capital will have to be kept by the banks, because actually the mutual fund has defaulted, they have undertaken the measure that they are defaulting, and in this case the capital will have to be maintained by the bank now. Okay, now the underlying exposures of banks to their counterparties, let's say that the mutual fund want to do the investment of 100 crores. So that means this much of irrevocable permissible commitment is going to be given by the bank. So that is limited by the large exposure framework. So large exposure framework says that a bank cannot lend or cannot give the commitment of more than 10% of the bank's eligible capital base to a single counterparty or a group of counterparty. Okay, so there are the large exposure limits. Sorry, this is the large exposure definition, that if the large exposure is actually the big exposure that the bank is doing with a particular counterparty. So the banks, if they are lending till equal to or above 10%, so this will be considered the large exposure, and there are the limits on the large exposure, that more than 20% cannot happen for the single counterparty, and more than 25% cannot happen for the group of counterparties when there are some norms that are there. So large exposure means that large exposure is the loan, is the money that is going from the bank to a single counterparty or to a group of counterparties. So large exposure will be considered when 10% or more than 10% of the tier 1 capital is given by the bank to a single counterparty or the group of counterparty. So this is considered the large exposure. Now there are the limitations on the large exposure that I have taken a session on. You can read the limitations on the large exposure. But the basic idea is that the banks, if they are doing the irrevocable payment commitment, that should be under the large exposure framework. The limits should not exceed what has been mentioned under the large exposure limits. Now it has been said by the Reserve Bank of India that as per the if there are any trade that is happening for the T+2, for the T+2 settlement cycle, if there are any shares that are being traded on the T+2 settlement cycle, so the same norms will follow for these trades that were written on 2011. So that is the maximum risk to the custodian bank issuing IPCs would be reckoned at 50%, because let's say this is the trade day, that is Monday. on Tuesday, on Wednesday. So on Wednesday, the settlement will happen. So on Monday, the trade is initiated. The irrevocable payment commitment has been given. So on this day, the price can fall. On Tuesday, the price can fall by, let's say, 20%. On Wednesday, when the trade is being settled, on Wednesday also the price can fall by 20%. So that is the downward price movement can happen, and let's say 10% extra, the downward price movement can happen. So in total 50%, the maximum risk to the custodian bank issuing the irrevocable payment commitment would be reckoned at 50% on the assumption of downward price movement of the equities bought by the the foreign institution investors and the mutual funds on the 2 successive days from the T+1 and T+2, 20% on T+1 and 20% on T+2 until the settlement is happening. The prices can fall on the first day, on Tuesday, and on Wednesday also, with an additional margin of 10%. So I hope you understand that for the T+2, the capital market exposure is considered to be 50%. So the capital will have to be kept as per the capital market exposure. For the T+1 settlement, for the T+1 trade cycle, the capital market exposure that is being kept is at 30%. So directly the questions can come from this exposure point that you have to remember. Okay. Now IPC will be treated as financial guarantee with a credit conversion factor of 100. That means if the IPC is given, if the irrevocable payment commitment is given, that is actually a kind of credit that is there. Okay. And this will have the risk weight of 125%. So that is the complete idea. Now if there is any confusion, you can tell me. Yes, this was a little typical because this was complete like financial segment that you can understand. But one thing that you have to understand is that there is the norm that has been changed, particularly from 50% the risk weight has been reduced to 30% because from T+2 the cycle has changed to T+1. Nothing major that has changed. Other than this, yes, you might have to watch this session again so that you are able to understand this clearly. Okay. Any confusion, anyone? Saurabh, that depends upon the relationship between the bank and the client. So I don't think that the bank will want to hold the shares. The bank will want to sell the shares in a fast manner so that it can gain back the money, so that it can give the loans or something else. Okay. So the bank, they continuously do the transactions. Nostro, yes, it is the domestic bank. It is the domestic account of the foreign bank or of the foreign customer. Okay. Credit conversion factor means that, see, the IPC will be treated as financial guarantee that is being given by the bank. Now this can be, now if the mutual fund is not giving the money, okay, and mutual fund wants that to keep the shares, so that will be considered a credit. That will be converted into credit of the mutual fund. That means the bank has given the credit to the mutual fund of 10 crores rupees. So it will have some interest rate also. So that is the idea of credit conversion factor. Yes, 50% of the maximum risk to the custodian bank issuing the IPC would be reckoned at 50% of the IPC, that is 20%. IPC is the irrevocable payment commitment of 10 crore. So on the first day, 20% downward price movement can happen. On the second day also, the 20% downward movement can happen, and 10% is taken as the margin. So in total, 50% of the settlement amount, it is considered as a maximum risk to the bank. Okay, so that means 5 crore is the maximum risk. Yes, it is 50% of the IPC. So maximum risk of the custodian bank issuing the IPC would be 50% of the IPC. Any confusion now? So see the session again if you require to understand it in depth. So you will have to see the session again. Okay, I have tried to break it down as much as I can, but this is a difficult notification. So try to see the session again so that you are able to understand the nitty-gritties. So this is the first question. I hope you will be easily able to answer this question now. Now this is the second question. So try to answer this question. If you are able to answer both the questions, then for sure you will be able to understand. Okay. If you are able to answer both the questions, that means you have already understood the major idea of the notification. So now before ending the session, there is a big announcement from EduTap that we have brought for you the comprehensive guidebook for RBI, NABARD and SEBI, so that through a single guidebook you are able to get much of the information regarding the examination, regarding the syllabus of the examination, the pattern of the examination, even the previous year questions you can get with this guidebook. So the link of this guidebook is provided in the description box below. So you can download this. Okay. So this is it. Thank you so much. If you have any confusion, we can discuss this in the next session also. You can comment down below also any confusion that you have regarding the session. Okay. So thank you very much and have a good day.